Investors tend to have mixed emotions around volatility. But the truth of the matter is that investment portfolios, unlike savings accounts, are designed to experience volatility. I'm going to explain in this video how investors overcome their mixed emotions about volatility and how they learn to accept it. Successful investors expect volatility. So what is volatility? Volatility is the fluctuation of returns around a long-term average. Here in this chart, you can see daily returns of the well-known FTSE 100 index of large UK-listed companies. It's a very noisy picture as returns daily fluctuate between positive and negative. There are many positive days and just as many negative days. Some of these larger negative days can feel very scary, with the media often amplifying this fear. But we must put this into perspective. Looking instead at returns over 1 year, not just one day, we see they are far less noisy, but there are still plenty of negative outcomes. The horizontal line in the chart takes a much longer view, showing an average annual return since 1990 of just over 7%. As you can see, year in, year out returns fluctuate around this average, but the patient investor was paid a high average return for this volatility. Now, all this underlies an important principle in investing. Over the long term, the more risk you take, the higher the returns you should expect. Though, of course, you must also remember that in some instances this may also mean more losses. The usual higher risk, higher return dynamic is what we call time diversification. Patience is a virtue when it comes to investing. So here's what the long-term risk-reward trade-off looks like in theory. The more risk you take on the x-axis, the more return you would expect on the y-axis. However, the theory doesn't always reflect reality. The next chart shows a variety of assets organized from low to high volatility using data from 1990. You can see that time diversification has not dominated asset markets over this period because, for example, the lower risk UK gilts or UK government bonds have had a higher return than the riskier Japanese equity market. So what is going on here? Why is time diversification not working? And the answer is that special or idiosyncratic factors were at play over this period. Assets can potentially be subject to unique effects. Over these 30 years, inflation mostly trended down, and that boosted UK government bond returns. Emergency low levels of interest rates that followed the global financial crisis also boosted UK bond returns. Meanwhile, during the bulk of these 30 years, Japanese equities suffered from a stronger currency trend and from losing export markets to China. So it is clear, just having a long-term time horizon does not diversify away some of these special idiosyncratic effects. And that's where asset diversification comes in. If, instead of investing in a single asset according to its expected volatility, we invest in a multi-asset portfolio, the long-term returns will be diversified not only by time, but also through asset diversification. The next chart shows the simulated returns since 1990 of Nutmeg's fixed allocation multi-asset portfolios across 5 risk levels. A is the lower risk and E is the higher risk. The line is upward sloping, as we'd expect. The higher your target volatility, the higher the return you should expect in the long run. So there you have it. When you hold a Nutmeg multi-asset portfolio and when you take a patient, long-term view of your investment plan, the higher the volatility, the higher you should expect investment returns to be. The key decision for Nutmeg clients is to set their risk exposure in line with their return expectations and their personal capacity for potential loss of capital in the short to medium term. Remember, volatility is a natural part of the system. In Nutmeg's fully managed portfolios, the investment team aims to help cushion this volatility, but cannot remove it altogether. Remember, volatility is a critical part of the investment journey. Clients in fully managed portfolios can rest assured we are working hard to ensure portfolios are positioned appropriately, not only when markets are showing stress, but also in calmer times.